Patanjali Keswani joining us now. He's chairman and MD Lemon Tree Hotels. Great to speak with you, Mr. Keswani, and great to have you on NDTV Profit as always. Let's start with your outlook and a sense of the kind of demand that you're seeing and what is a crucial period in December.
So, good morning. I'm seeing very good demand compared to last year for Lemon Tree. And as you said, typically winter is obviously the better part of the year. So H2 is typically 15-20% better in revenue terms than H1. So that is very much playing out. And in fact, I think it will be better than, significantly better than our relative performance last year on a year-on-year basis.
Saying this quarter, Q3, will be significantly better than last year on a year-on-year basis, is it?
That's right.
Okay. And then also the other news flow which we keep hearing about Lemon Tree is all of the new signings and I think rapid expansion geographically. What is the strategy there?
So actually there are two parts of the strategy. One is one is reactive. Owners reaching out to us to be included in our network. Where they get the advantage of obviously brand access to distribution, to customers, to our loyalty members, and also our cost structures and so on. So which is a purely outreach to us from a financial network perspective. Then there is a strategic aspect, which is where we make specific outreaches, which is very proactive, where we think there are markets where we should be present and we are not. And these are primarily because they are relevant to our network. They also enable us to access new consumers who are in those cities who are not so familiar with our hotels and our network. And therefore, it's a combination of both. And we are accelerating it. We've signed over 20 hotels in the last 3 to 4 months. I expect we'll sign another 20 in the next 3-4 months. And ultimately, all these will become operational in the next 2 to 3 years and take us to our announced target of 20,000 rooms by 2027.
Mr. Keswani, good morning, Neeraj here. Trying to think out loud, I mean, some of your peer groups have said that while this industry has largely remained a structural or a cyclical industry, there is every likelihood that it may not remain so and may actually become structurally a long-term non-cyclical industry if indeed India continues to grow 6.5%, 7%. You've spoken about the 3-year targets of the numbers that you reach. Typically, that would mark the end of the cycle which started 2-3 years ago. Do you believe this time around might be different?
I absolutely believe it. And whatever my peers are saying is based on actually the inflection point of India's GDP per household, where we are currently. So we are roughly at $2,700-$2,800 per person, or about $12,000 per household. But if I do this across a distributed set of income earners, then the number of Indian households. So see, there are 32 crore households in India. And only about 3-4 crore households are actually what you and I would consider real consumers of discretionary items. So when I look at India's GDP per household today, and I just project a 6% growth over the next 5 years, and then I overlay it with some very interesting indicators like the fact that the number of airlines in India, the number of aircraft in India or aircraft seat in India is going to grow nearly 3x in the next 5 years. The number of airports is going to nearly double. The number of runways are going to more than double. The number of 4-lane highways in India have doubled in the last 5 years, and I'm informed will double in the next 5. The number of SUVs that are sold in India are skyrocketing with hatchbacks. The number of Vande Bharat trains, and then I overlay it with this income shift. I think that the number of consuming Indian households will grow from maybe 5 million or 6 million or 8 million to about 30 million, which means that there will be enablement from income and from connectivity, which means obviously that there will be a huge uptick in demand, and it will not be an annual demand of growth of 7-8%, but more like China and other countries who went through the same change, where there will be a growth in demand of 20-25%. And then after 5 years or so, that will be the new reset. And then we will go back to this cyclical thing because there'll be high demand and by then I hope some high supply additions. This will happen not only for the discretionary sector of travel and tourism, it will also happen for a bunch of other discretionary sectors. For example, athletic wear, for example, footwear. So I'm very bullish over the consumption sector. And we who are part of it will benefit enormously, in my opinion.
So, Mr. Keswani, if indeed it's about 20-25%, the number that you spoke about for the next 5 years, what does that do to one of the market leaders like yours? I mean, would your earnings growth or revenue growth actually be northwards of that for the next 5 years on a CAGR basis?
Absolutely. So see, demand for hotel rooms where supply is fixed, any industry where supply is fixed, which is, for example, it could be coal, it could be oil, it could be buildings like hotels. A 1% change in demand leads to a 10% change in pricing because you can't add supply in the short term. So my expectation is we'll go back to the last upcycle we saw, which was actually not for these reasons. It was just due to the economy expanding fast, which was in 2004 to 6, where every year the average rate changed by 30-40%. So when I look at it very, very rationally, in absolute rupee terms, our average rate today is 30% less than what it was in 2007. And I have no doubt, absolutely, that in the next 5 years, average rates in India will start trending towards average rates of Asia, which means they will increase 2.5, 3x.
Keswani, it's also Samina joining in. And now let's talk a little more company specific, right? You did indicate to Tamanna that the wedding season, this season generally is a good season for hospitality. The other standout has been that in the previous quarter, while occupancy had declined, your average room rate had actually gone up by over 3%. Now we are in a season time when the outlook looks far more promising than the previous quarter. How are you feeling about ARR? Will that continue to improve? Could we expect the average room rate also to go up in the next couple of quarters?
So asking me about ARRs is like asking an airline about, ASK, or asking Bharti about ARPU. I would not look at it strictly from just average rate perspective. Average rates have gone up and will continue to go up quite significantly. What will actually change is the revenue per available room. Ultimately, when you have a lot of owned hotels or you're managing hotels for other owners, what the real metric you want to look at is the return per square foot. Okay. And what is your fixed and variable cost below that return per square foot, enabling you to get some kind of a return on your investment in these assets. My view is that average rates and occupancies are going to continue growing. Occupancy will grow by maybe 7, 8, 10% from, from say 70% to 75, 80%. But rates are where the future lies. And as I said, rates will grow by 10, 15% every year, in my opinion, in the next 5 years. And 90% of that will go to your bottom line.
Swani, a little more company-specific conversation. You've reduced your debt by about 20 crores. What is the roadmap to turning debt-free? Because I know that's a priority of some sorts. And also, what will that do to future capex plans that you have? Is that built in?
We will cross a cash flow generation of 100 crores from this, 800 crores, $100 million from this year. That will be our EBITDA. So earlier we were allocating this capital to a bunch of initiatives, which is catching up on renovation for our portfolio post-COVID. We were also focusing on heavy investments in digital transformation. So all these will kind of get done in the next 1 year. And then this cash flow will simply become available for debt reduction. So I think we will 100% be debt-free in the next 3 to 4 years. However, if we list our asset company, which is in a joint venture with a Dutch pension fund manager, where 80% of our debt resides, then we will go debt-free the week after we list, literally. And that I have said quite openly and publicly is something we intend to do in the next 12 to 24 months.
So has that timeline, and the last time we spoke, Mr. Keswani, also you gave us this timeline. Has that timeline remained the same, reduced?
Yes,
Are you going to
very
see
much.
it in calendar year 25?
Well, you see, it's a process. It'll either be an IPO or it'll be a scheme of arrangement. We have a certain, well, we can't be 100% certain about, the time because it goes through various agencies. But certainly in the next 18 months, um, we should list it, in which case the debt-free will be in the next 18 months. Otherwise, in the worst case, we'll be debt-free in the next 3 to 4 years.
Just want to get your outlook on the management fee component. If I'm looking at your Q2 numbers once again, and management fees saw an uptick. You've also obviously signed a lot of new companies on, or now have a footprint in large parts of India. Meghalaya, government of Meghalaya was the recent one. How are you seeing revenues from management fees growing overall and for this financial year?
So the government of Meghalaya was actually we've taken an existing hotel on lease. We intend to break it, and it will be a part of our owned portfolio, so to speak, with the land given to us on a long lease. And it's a market we are very, very bullish on. Plus, we want to grow more aggressively in the Northeast. As far as the managed portfolio goes, see, our managed fee income this year will be about, from non-owned hotels will be 70 crores, and from owned hotels will be maybe 120 crores. So maybe about 200 crores. If I look at all the hotels we are signing and the likely addition of new hotels, then my best guess is that in about 3 to 4 years, our management fee income will be north of about 350 crores. Okay, maybe even 400 crores. So that's something that is nearly certain. And if we aggressively add more hotels, as we hope to, especially under the franchise route, then this could be a high number.
Also, could you provide some more details on the shift towards the 70% plus asset-light portfolio? By how much will this impact profitability and operational efficiency over the next couple of years?
So see, today we have 6,000 owned and about 4,500 managed rooms. We've said we'll hit 20,000 in the next 3 years. At 20,000, really, this 6,000 owned rooms will grow very marginally. So we will anyway be 70-30 then. Typically, we earn, if I just take a simple number, we earn 13-14 lakhs per owned room in terms of EBITDA. So these 6,000 rooms should give us an EBITDA of about 850 crores, which is what I was talking about $100 million. The managed portfolio, for every 7 rooms, we get the EBITDA of 1 room because that's our share of the fees. Now, the fees is typically 1/6 of the EBITDA. So we have 13,000 rooms under management, or 14,000 to hit this 20,000 number. It is like owning 2,000 rooms, roughly. So 2,000 rooms will give me another 250 crores of EBITDA. So add the two together, we are talking about 1,000 to 1,100 crores of EBITDA in the next 3 years. Take out the below the line expenses, and by then I expect interest will be nothing. So you're really talking non-cash depreciation and corporate expenses. So you should have, and then take out tax, you should have free cash of about 800-900 crores a year, which is why I said we will be debt free anyway, and it will be more than enough to also solve for any capex requirement for growth in the asset company, which is a subsidiary currently of the main Lemon Tree.
Very lastly, Mr. Keswani, of course, we would love to understand, and I know there's enough and more demand in our country, so very little reason to look outside, but any global expansion plans, anything on the international market? Because I'm just assuming that while revenues may be one piece of it, those businesses may be a little more profitable, right?
So, if you look at the top 5 hotel companies in the world, you can really look at their growth using an XYZ axis. I don't know if I'm making sense, but most hotel companies started with one brand in their home country. They grew that brand, then they expanded across brands, that is price points in that country, and then they moved to other countries where their loyalty members were going. And then over time, they saturated all markets. So this is roughly, and there's no rocket science. This is what Marriott did, this is what Hilton did, this is what all of them did. India is no different. Now, the interesting thing about India is India has only 11, 12 million foreign tourist arrivals coming in, but 25 million Indians are traveling out. And it is my expectation that if I look at this structural shift in consumption and this growth in airline traffic, I think these 26 million Indians will start hitting insane numbers, like 100 million Indians will be traveling overseas by the end of this decade. What does this mean? It means India will become one of the most important outbound markets in the world, like China was some years ago, Japan was 15 years ago, America continues to be, and so on. Which means hotels worldwide will start catering more to the specific needs of Indians, whether it's in cuisine or in multiple ways. Now, if we are growing our loyalty program within India for Indians, and we are very, very focused on being an Indian brand for Indians, then certainly we would like to go to those cities where these Indians are going. So we've identified about 12 cities. I think on a Pareto basis, 80% of Indians travel to the cities we're all familiar with, whether it's Dubai, whether it's Nepal, whether it's Thailand, the cities there like Bangkok. It's a no-brainer that any Indian brand with a strong loyalty program should be there to attract those customers when they leave India. So strategically and partly opportunistically, we will grow there. We will grow in an asset-light way, and it will be linked directly to the growth of the Indian household income and the growth of this bunch of Indians who will travel internationally.
Thank you so much, Mr. Keswani. Pleasure speaking with you as always.